All right, welcome back, everyone. And we're going to do the exciting part is to actually apply what we learned so far, right? Because theory is just theory, but we got to apply what we learned. Well, this is just a simple example right here. It's not um, as close, but it's as close as it can be. And we're probably gonna create a few videos and real and actual statements or evaluation of a company. But for now, this is a quick and easy example to apply what we just learned. And so let's read the question. Use the following information to estimate the intrinsic value for a share of a company's stock as of March 1st, 2020. So keep note that it's March 1st, 2020. And, as soon as you read this, oh, it's December 31st, 2019. Well, that usually happens, right? Because sometimes we have the end of year data. We still have not yet received the most recent report. So we're going to show you later on how to adjust for that later on. But just keep in mind that's March 1st, or how many months basically. So December 31st, right? So end of month. So your next month would be January 31st. And then February, let's just say 28 or 29 or 27. I don't know. Uh, so let's just say February 28. And the next day of February 28th is March 1st. So basically, you only have 2 months. Let's just keep that in mind. All right, next thing is no plat, which we just talked about. Invested capital, your dividend yield, cost of equity, WACC, your net capex is right there. Your no plat growth is right there. So we can see that, okay, we probably need to grow this by this. Probably need to grow invested capital by the capital expenditures. And, well, actually, let me make this a little bit bigger uh, than the PowerPoint. Uh, that's fine. You can probably just see it fine. And then the left side would be the formulas or, the theory. And then we see a bunch of items that we need to adjust afterwards. And then you have your shout. I like to call it shout. This sounds awesome. Shares outstanding. All right, discounted cash flow. Let's start. So, to prevent confusion, I always want to start right here. So, we see our growth rates, and we always start with no plat, right? Because no plat minus the change in invested capital. We're trying to find the free cash flow right there. So, I'm just gonna put no plat growth. Oh, so and I'll just start with actually, let's just say time right there. So I'll start with 0. For some reason, this thing takes too long to load. Let me, except for data tables. I don't think I have data tables. Oh, I have this open. So let me close a file. All right, let's close. So it should be faster by now. Okay, 2, 1, 2, 2, 3. Uh, maybe I should do that. 2, 3. Well, 0 is and 2019. So I'm just gonna add a row right here, and let's just say year 2019. So take the previous year minus 1, and then drag it to the right. Hopefully the numbers doesn't look too small when I'm doing this. Um, but you can always zoom anyway, right? With the recording, so I won't have to worry about it as much. All right, so maybe I'll zoom in a little bit. How about that? All right, no plat growth. Let's see, 2020 E. I'll just put negative 75%. Oh my God, what happened? Well, there's COVID, right? So that's why it's negative. And then it recovered to 300%, and then 5%. Uh, I don't know why it has that thing. All right. So you have your growth right there. We just brought it down, basically. And now we can calculate your no plat. So we started with what, 4,000, and now we we take the before and then we grow it by the growth, right? And then drag it to the right, boom. So they had 4 billion. Looks like an airline, right? They lost 75% of their revenue, and then they recovered the next year and then grow a little bit. Well, what's next are capex and invested capital. Well, how about we put our assumptions on upper side and then our um, calculation down. How about that? So I just rearrange it a little bit. You could pause the video how I did it, but it's not rocket science. We had 1500 for 2020, 500, 1500. So we started with an invested capital of 28,000. Might as well put a comma, and then we add the capex, net capex. So basically, we're buying more planes. If this was an airline during COVID, even though we have a negative growth. So right there. Well, what's next? You have your no plat. You have your invested capital. Well, you don't minus this, right? Because it's the change in invested capital, which is basically your capex. So I might as well rearrange this again. Maybe I had the right format. So it was like this. No plat. And maybe I should have done this. Okay. That looks better now, right? So now, the change in invested capital is basically your net capex, right? Maybe I should say net capex. So now we take the no plat that year minus the net capex. Oh, we actually have a negative free cash flow. Well, now we have the free cash flow. Uh, well, what do we need to do? Well, we need to find the terminal value or the continuing value, and it says right here, starting 2022, the growth will be 5% and beyond. The same thing with the capex as well. Is it 5%? Let's see. So yeah. What we need to do is take the continuing value. So let's find the continuing value formula from the presentation. It's this one right here. So we take our no plat, t plus 1, so we 2022 with 5% growth, right? Times 1 minus g, which is 5%, divided by return on invested capital. Oops, we don't have the return on invested capital, so let me try to calculate that one first. So what is return on invested capital? It's a return on your NOPLAT let me add a line. It's your return. So you have your NOPLAT. Maybe I should uh, maybe I should move this over here and do that. How about that? Basically copying the NOPLAT. So you take your NOPLAT divided by how much was invested last year, right? So this is the return on what you earned that year divided by what you had last year. And that should be in percent. And your NOPLAT or your ROIC, return on invested capital, is 14%. So we have that now. We need to do the formula again. So NOPLAT, T plus 1 times 1 minus G, the long-term growth, divided by ROIC, close parenthesis, divided by, need one more close parenthesis, divided by WACC minus G. Where's our WACC at? 8%. There we go. 8% divided or minus growth of G, 5%. So this is your terminal value. I'm just gonna insert WACC right here just to make sure. 8%, and instead of referring to the inputs over here, I'm just gonna change the input right there. Same number, doesn't change anything. So CVT is equal to 2. So now we have our present or our free cash flow. So I'm just gonna sum free cash flow, easier. That plus that. So basically we have 2, right? This one and this. Because why aren't we including this? Because it is already incorporated over here, right? Because we used the NOPLAT here to calculate the terminal growth value after 2022. So what we need to do is PV of free cash flow. So this divided by the WACC. Oops. 1 plus the WACC to the power of how long are we gonna get that money? So in 1 year, just 8%. And then if we drag this formula down, oops, I should have made this absolute. There we go. And all we need to do is PV of free cash flow. That plus that. So that would be the value of operating assets. So I'm just value of operating assets. All right, we have the value of operating assets. Now we're basically the sum of all the PV, right? So now we have the value of operating assets. What we need to do is adjust for this, right? So I'm just gonna take a screenshot of it and put it over here so we can see it. Okay, and now I can just delete this later on. So this exercise is really trying to test you on how do you calculate the continuing value, and especially what should you include when you adjust below the line. So what do we include below the line? So let's start with normal cash. Do we include it or not? Well, normal cash is what we use to run the business, and that should be part of the invested capital, right? And then you have your actual cash. What we need to get is the excess cash. Well, if we take actual cash minus normal cash, it's negative. We actually probably need more than what we have. So we don't really have excess cash. So it would be zero. Why is it not negative? Well, we don't have that cash in the first place, right? Because that's the normal cash needed to run the business. All right. Next one is short-term investments. Do we include it on below the line? Um, yes, of course. Term investments. Why? Because we're not in the business of uh, investing money, right? Do we include goodwill? No, because that's made up. You don't want to include that. Deferred tax assets. Well, we use this to calculate no plats, so we don't include it below the line. PV of operating leases. Do we include that? Yes, because well, let me put the sign right here so it won't be confusing. Uh, all right. Maybe I should have a line to the left. All right. PV operating leases. Well, that's basically a debt, right? That's the ROU liability. So we include it and we adjust it less. How about PV of capital leases? Of course, we include it because that's basically that. Non-controlling interest assets. Do we include it? Of course, because we're not in a business on those, and that's below the line. 1500. Oh, non-controlling interest. It's positive. Deferred revenue. Well, deferred revenue is used to calculate IC, right? Because this is part of your uh, uh, liability. So we're not going to include that below the line. But you need to include it on the calculation of IC. Accrued liability is the same thing. That's part of your operating, right? So it should be included IC, but not included below the line. Accrued intangible assets. Do we include? We already included IC, invested capital, on the other long-term assets. Employee stock options. Well, we did not have it as operating, but it's a liability that we need to pay ESOP for our directors, and it's off balance sheet. So we need to include it, but with the negative, right? Because it's a liability. It's that basically, uh, and then that's the end. So take the sum. You get 6148, 488, and there's probably some decimal places. I'm just gonna hide it since it's not significant. Well, what's our shout? Shares outstanding. What was it 1200? So you divide it by the shares outstanding. Now you have your IV, but on 1231, uh, because the data is from 2019. The latest data is from 2019 because they haven't reported first quarter yet. And so, well, today is 3 March 1st, right? So we need to adjust this to incorporate today's price. So what do we need to do? Well, we take the price times 1 plus. Uh, well, we need to grow this, but by how much? Well, what is your cost of equity? Because that's the equity, right? After everything else, your debt holders, um, and other, is just the value of equity. So you grow it by the cost of equity, which is 10%. And then, since you're giving out dividend, you also want to incorporate that to 2%. And this is basically your growth, right? You take out the retention ratio, the dividend. So what's left is the retention. um, and then it's only for 2 months, right? Remember, like I said earlier, it's only for 2 months, for January and February. So what we need to do is to the power of 2 divided by 12, right? Because if we don't have this, then that would mean that'll be the next year's price. So you just want to incorporate 2 months. So you only raise it to the power of 2 divided by 12 because there's 12 months in a month. And so this is our intrinsic value. All right, perfect. That's the first example, and congratulations for getting the intrinsic value as of today. Well, well, what if as of this day? Well, what if, for example, what if the stock market price is trading at, let's just say, $60? Would you buy it? Uh, well, your value is $51 or $52, but it's trading at $60. You don't want to overpay, so you basically don't want to buy the stock because it's too expensive, right? So let's just calculate the downside or upside. Let's just say upside or downside, and then margin of safety. So how do we calculate upside or downside? So you just take that divided by the intrinsic value divided by 1. Oh, I'm sorry, I have the reverse. So you just take your IV divided by your stock market price. So your base of truth is um, what it is right now, and it should supposed to be this much minus 1, and you have downside of 13.5%. Well, how do you calculate margin of safety? So usually downside and upside are used in the sell side, and margin of safety is commonly used in the buy side because you're buying stocks, you're investing. Sell side usually sell, uh, for their services, so they use the term upside and downside. Basically, your potential return, and margin of safety is your buffer. So the basis of truth is your your um your valuation. So let's say that divided by that, and that's your MOS. So your base of truth is the 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 price, your intrinsic value, the price that you figured out. The upside and downside, your base of truth is what it's trading right now. If it's negative, then why would you buy it, right? If your potential earning is negative, if you lose money, then why would you buy it? Um, well, let's do another example. Let's say the stock market price right now is $40. What is our upside? Our upside would be almost 30%, right? Because $10, well, basically $12. You increased by $12, 30%. Well, your margin of safety, what is my buffer zone? 23%. So that's how you calculate. So again, how do you calculate IV divided by market price minus 1, or basically um, this divided by this minus this, or I just made it simple, this divided by this minus 1. It's the same, it's just algebra. And then for margin of safety, it's 1 minus your current market price divided by your base of truth is your IV. Both are positive, both are negative. All right, that's for the first example. We're going to go through the second example, which is the ROIC, on the next video.